and welcome. You're watching Financial Plan, and over the next 30 minutes we'll talk about investments, but we'll talk about a very different kind of investment vehicle, which is alternative investment products. Joining us in the studios is Feroz Aziz to talk about the same. Thanks, Feroz, for joining in. Feroz, we've talked about the traditional vehicles of investments such as mutual funds and equities and in debt. What we've not talked about is alternative investment products. Take us through what is alternative investment products to begin with.
See, when the conventional products can't meet a specific need with respect to return, aspirations or risk mitigants, there comes the need of something which is little unconventional to be able to complement the portfolio. Those instruments are called alternate products. Some of them, being alternate, turn out to become a core portion of one's portfolio over a period of time of learning. In India, there are about 4 or 5 kinds of alternate products which, very importantly, should fit a need which the conventional ones can't actually fulfill for you.
Okay. What would those needs be?
See, the needs are only 2. One is if the returns you're making out of a conventional product are not able to meet your objectives or your goals, or the risk you're taking using the conventional products is on the higher side. There are so many objectives. Now, for example, if you want to reduce risk and still be in the equity market, mutual fund has only one product to offer, which is called the arbitrage fund, which has a return of 6-7%. If with the lower risk you want a return of 12, 13, 14%, it becomes a tougher task. In the conventional products, you have 2 products. One is the debt instrument where your capital is protected and your return is also more or less protected. On the other hand, you have equity, where your capital is not protected and your return is not protected. If an alternate could fill the need of this large gap, then that's a suitable alternate product to consider.
Feroz, it's tough enough convincing an individual to start investing in the equity markets to create wealth. I'm only assuming it's only tougher to convince somebody about alternative products because I think the reputation alternative products carry is that they're high risk in nature. Is that correct?
Correct. They carry a reputation of all alternate products carry a higher risk kind of a perception. And since they're higher risk or require more sophisticated explanation, this has been limited to those guys who can actually afford buying them. So like a mutual fund has a 1,000 rupee limit, alternate products have a limit of 25 lakhs and upwards.
So it's fair to assume that alternative investment products are not suitable for everybody.
They're definitely not suitable for everybody. At a stage of the beginning, you have to traverse this journey to become a learned investor. And then you might want to have a larger portfolio size, which actually is conducive for an alternate product infusion into the portfolio.
As a financial advisor, how much would you recommend in terms of allocation towards alternative investment products versus traditional?
See, alternate investment products are quite a few. In my opinion, it's very, very important to eliminate most of the alternate products.
We'll talk about that in a minute.
Yeah. So if somebody looks at a specific good alternative to mutual funds, then it should be 30%.
30% out of the mutual fund exposure.
So if you have 100 rupees.
And this 30% is out of equity mutual fund portfolio or debt mutual fund included?
Yes, so if you have 100 rupees to invest, in my opinion, the alternate product or something beyond mutual fund, not even necessarily alternate, needs to be 15 in the debt category, 15 in the equity category. And 70 rupees goes into mutual funds in the debt and the equity mutual funds.
Right, so let's talk about what these alternative investment products are. What are the various types of products that are available in the market?
See, there are about four types which are distinctly different and might be worth evaluating, but not investing maybe. So structured product is one of them, which is not necessarily an alternate product. It is a bond. So that's closer to an alternate product, but it's beyond mutual fund. That's one. Then you have PMSs, Portfolio Management Services, which is a customized equity investment generally. That I would consider beyond mutual funds, of course. And the third is real estate funds, who try and borrow money from people or get monies invested and lend to maybe builders or invest in properties. That's a real estate fund. Private equity fund is the last alternate product where money is collected to invest into unlisted equity, not the listed equity, but listed equity.
Right. I just want to, we'll talk about all of them in more detail because I believe, Anand Rathi is also pioneer in structured products, right? So, of course, you'll have more analysis on that in the next segment. But how does, you talked about how these products are slightly more complicated than your normal off-the-shelf mutual funds. If one is looking to purchase or invest in these products, how does one do it?
See, importantly, structured products is one of the products which we have been into, and that's one thing which is simple to buy. May not be as simple to comprehend, but if the explanation is given, it's easier to understand. Most alternate products, like PMSs and structured products, not need a demat account. Okay, but a mutual fund does not require a demat account. So if you've gone through the journey of mutual fund investing, and if you have to graduate to something which is like an alternate in the structured product in the PMS category, you would need a demat account for yourself. That's the first step, and then you choose your PMS product, PMS or a structured product, and then buy it with similar kind of documentation. It's not as difficult to buy it.
Internationally, buying an alternative investment product is as easy as a click away. So it actually is as simple as buying into a mutual fund. Here in India, it's not as easy, right? I mean, are these alternative products created by fund houses? Is it created by financial advisors or wealth management firms like Anand Rathi? Where is the game?
See, if you look at alternate products, it's always wise to buy an alternate product not online. Figuring out and understanding what you're getting into is the most important thing when you buy something beyond a mutual fund, right? So ease of investment is not actually a prime requisite. It's the understanding which is a prime requisite. Who issues these? For example, structured products are issued by non-banking financial corporations, NBFCs. And so those bonds get credited to your demat account. Buying a bond of a company is simple, and structured product is nothing but a bond, but which has a return commitment which is variable. Like a bond tells you that you will make 8% return, 9% return, and a fixed return. But a structured product has a variable return, but it's nothing but a bond which has a variable return. So it's simple to buy.
Right. On that note, we'll take a break. We'll come back. We'll talk a little bit more about the various sort of structured products and, of course, alternative investment products that one could consider investing in. Stay tuned. Welcome back. You're watching Financial Plan, and we're talking about alternative investment products. Feroz, in our previous segment, we talked about the importance of alternative investment products and, of course, the role that they play in a financial portfolio. But there are a whole bunch of alternative investment products out there in the market. Let's start with structured products, because I think this is a subject that you understand, enjoy, and, of course, are also pioneer in. So tell me more about structured products. Who should be buying this? Who shouldn't? What are the features of this product? What are the kind of returns one can look at?
So the features of this product and why should somebody buy, what extent, these are very important answers you need to have in your mind crystal clear before you enter any of these kind of products. So structured products, in my opinion, should form 30% of one's portfolio, clearly. And that becomes your plan B of your portfolio from an investment standpoint. If the market does very well and things go as envisaged, like India is looking at a bull run in the next 1 year, 6 months, 2 years, nobody knows when, but there is enough to say that we have ingredients for a bull run. If that happens, mutual funds make me money. If the market disappoints, can a structured product still give me that 15, 16, 17% return? Then it becomes a plan B. So structured products should be bought in the form of a plan B. What a mutual fund can't do is what a structured product should do. Second thing when it comes to structured product is you should never buy a product which is a short-term product, like a 1-year product or a 2-year product. You should buy a longish kind of a product, because structured products can actually be redeemed but cannot be extended. Like a mutual fund, you can invest for 20 years, 10 years, 15 years. A structured product has a deadline. So they should be not shorter in period, longer in period, but they can be redeemed. So this automatically can give you a return between debt and equity. Equity has unlimited upside. Debt has a very little return, especially after interest rates have fallen. So a debt kind of an alternate structure product, which is low on risk, gives you 12-13% return, which is marginally higher on return, risk makes 16-17%.
So what is the risk profile of these structured products as compared to equity and debt, equity mutual funds and debt mutual funds?
So this will have a lower risk than an equity mutual fund, and higher risk than a debt mutual fund. So it tries to fill the gap which the mutual fund industry is not able to fill.
Right, Feroze, these products tailored to one's portfolio, or are they commoditized like mutual funds?
So they're not as commoditized as a mutual fund, but there is some degree of customization possible. But that's the next level of actually buying a structured product. Unless you are so accustomed to buying them, would you want to customize something for yourself? The answer is no. After you've had 10, 15 structured products whom you have lived through, then your understanding of them goes up, and then customization should be used.
Feroze, you said that it's always recommended to buy these products offline and through an NBFC like yourself, maybe, only because they're complicated, execution is a challenge. One of the biggest strengths of mutual funds is that it's a click away. The execution is extremely simple. If buying these products is so complicated and not so easy, selling them is going to be as difficult, right?
See, if you've actually, you've hit the nail on the head again. So if I would have conveniently bought it, if I wish to exit my structured products after a year, but I have a 3-year structured product, then I would still need human intervention. So it's important to actually do these transactions offline after having understood it. You're right that if I can buy a mutual fund online, so can I access my money online. But even if you got to buy a structured product, like globally you buy structured products online, but exit requires having to speak to those NBFCs who actually issued this product.
What is the average time horizon that you advise investors to invest in an alternative product? What I'm trying to get is, what sort of a goal would this financial vehicle suit?
So it's 3 to 4 years, near-term goals it can fulfill. For the number of products we have done, almost about 600-700 which we have done so far, out of which quite a few have matured. I think the most optimal return and the risk mix is between 3 and 4 years.
And are these products, so like we say, equities are recommended when you're expecting a bull run. Are these alternative investment products recommended when there's a bull run underway, or they can be also used during a bear market?
Actually, structured products are used between bear markets and languishing markets. On the bull market, the mutual fund will do the job for you. And when that doesn't happen,
that's where this becomes a plan B.
That becomes a plan B.
How tax efficient is this? Because again, one of the other key features of a mutual fund is that it gives you tax breaks. Alternative investment products, are they as tax efficient?
If I get specific of structured products, listed structured products are at 10% taxation and unlisted ones are at 20%. So this is the tax.
What do you mean listed versus unlisted?
See, there are some which are listed on the exchange and some which are not listed on the exchange. So where the principal is protected, then they are eligible to be listed. The ones which don't have a principal protection, they cannot be listed. If they cannot be listed, 20% becomes.
And you recommend both listed and unlisted structured products?
Yes, depending on the fitment it tries to carry in one's portfolio.
Right. Well, moving on from structured products, the other common alternative investment product that we hear about is PMS. And in the last couple of months, they seem to be making hay while the sun shines, right? I mean, the surge in the inflows into PMS is actually doubled, if not tripled. Can you give me more details of what is a PMS to begin with, and how is that different from a mutual fund?
See, PMSs have, like you rightly pointed out, this industry is almost 15 years, 16 years old. For the first 13, 14 years, it collected X amount. In the last 2 years, it's collected almost 5-8 times the money it collected in 15 years. In my opinion, PMSs, if you have to understand them before we do the analysis of it, are products which deserve some degree of customization. They buy stocks, but in your own demat account, and you pay a fee to a professional to keep a separate demat account where you are delegating the buying and selling of direct equity to that person. Like in a mutual fund, there's a pool concept where lakhs of people put in money and one person manages it. Here, there's a large client who puts in the money in his own demat account and pays a fee to a professional to manage his account separately. That's called a portfolio management.
How is this any different from an HDFC Security who'd recommend stocks to you, and an ICICI Securities would recommend stock to you? So what is the difference between that? Because to my mind, if a broker or middleman is going to recommend you 5 stocks, it's the same as a PMS, right?
See, one is he recommends me the 5 stocks. The buying discretion is mine. If it belongs to the manager and he himself will decide, not just recommend to me for my decision making, if he takes the decision on my behalf, then it becomes a PMS.
Why is this different? Maybe not different, but why is this So would it be fair to assume that mutual funds should be a preferred bet? Because I guess the fund managers handling mutual funds are far more qualified in terms of experience as compared to PMS managers?
See, I completely subscribe to that opinion, because all the large CIOs or the big fund managers today have graduated after having managed PMSs. So that's a natural growth path. So I would rather be in a more diversified portfolio of a mutual fund than a fund manager who's junior, who's aspiring to be a mutual fund manager. And if you measure a PMS on 6-7 parameters, all of the parameters mutual fund scores better, but still they are gaining more momentum.
Why is that, Feroz?
Yeah, it's an important question. But 2015 April, SEBI clamped down on the commissions the mutual funds can pay. Okay, little do people know that there was a circular sent by SEBI to all the people in the industry saying that now mutual funds commissions will be capped at 1% upfront. But PMSs can pay as much as 4-5% to the wealth manager who can actually give a PMS.
So PMSs are also commoditized. It's not as if there are a number of PMS managers out there. These are also products you can buy off the shelf?
Yes, you can buy them off the shelf, which itself is counterintuitive.
Which is very similar to mutual fund again.
Absolutely. And people have this tendency to believe that mid-caps, if you want to create a mid-cap portfolio, PMS is a better vehicle.
Not a mid-cap fund.
Not a mid-cap fund, but it's seen that the risks measured statistically are 2 times more on a PMS.
What are the kind of returns? Are the returns in line with the kind of risk you're taking on?
Ideally, for the risk you're taking on, you need to get at least 4-5% more than a mutual fund. Have they been able to do it? The answer is no, clearly. Some PMSs have been able to have flash in the pan 1 year, 2 year good performance. If you look at a 5-year time frame, it's actually underperformed mutual funds largely.
So which are the common PMSs that one hears about or talks about?
See,
are these also done by NBFCs or are these done by fund houses?
See, both the categories.
Okay.
There are wealth management outfits. There are few PMSs who are actually good, but I would still stay away from them. But there are NBFCs and asset management companies, both issue them.
Are they tax efficient?
They are lesser tax efficient because it's in your own demat account. 1 year, before 1 year, 15%.
So direct equity taxation is what PMS has. And what is the sort of access to your portfolio? Do you monitor your portfolio as often in a PMS as you would in direct equity?
No. Unlike direct equity, where you are calling the shots and you are picking up the phone, speaking to the dealer and placing the order, PMS, it's automated, just that you will get a transaction information on an SMS maybe from the demat account.
So even though while you deter investors for looking, for considering a PMS as an investment, what is the time horizon anyway? Because structured products is 3 to 4 years, like you said. PMS as well, is there a lock-in year?
There are exit loads, generally to the extent of 3 years. Like an equity mutual fund has a 1 year exit load. These have a 3 year exit load. Because anything which has a higher commission requires to keep the investor locked in so that can be remunerated.
So just coming back to structured products, is there any sort of penalty? Does an investor get penalized if he wants to exit before the maturity date?
No, actually no, because the term sheet as per RBI regulation clearly tells you to give the fair price of the bond at any given point in time without debiting the exit load, if at all any. So there's no exit load for a structured product.
We'll take a break on that and we'll come back. We'll talk about a few more alternative investment products and also talk about regulation. Who regulates these products? Welcome back. You're watching Financial Plan. In our previous segment, we talked about the importance and what are the features of structured products and PMS. Right now, we'll talk about real estate funds and private equity funds. Feroz, start with real estate funds because I believe these were launched in 2006. I think in the last few episodes, you've told our viewers umpteen number of times of why real estate is not an advisable investment right now. I'm not sure whether real estate funds is the same advice.
I think it's correct because the asset itself is going through its own challenges, and if you direct real estate doesn't make sense, through a fund route wouldn't change too much. So is real estate fund to be bought from a progressive prospective basis? The answer is no. How was, like you rightly indicated, 2006 was the first real estate fund in India, and that's finished almost 10-11 years. Now there's enough evidence and data for us to see the merit of doing it from a vehicle, from the product's perspective, whether they have delivered the objective objective which they set as themselves to achieve. I think that's a long period, right? So we did some research in terms of understanding 16 real estate and 8 real estate funds and also 8 private equity funds, and we realized that the kind of value that those funds have destroyed is because they committed 20 to 25% per annum return for the next 10 years, which means a huge amount of money should have actually come out of it. But if you analyze them for the last 10 years, the returns which have been generated are as little as 5.53% aggregate. Now that's like expecting 2025 and then being shortchanged 5.53 pre-tax, and then you have taxation, so you're left with no return. If you would have actually invested in a simpler product like a mutual fund, you would be left with almost about 20-22% IRR from the year 2006.
Feroze, talk about the features of these real estate funds and these private equity funds. What are they all about? Because if one is wealthy enough, they'd rather just go buy real estate directly, because alternative investment products is not recommended for, you know, the average strata of society. So it's sort of, again, confusing, right? Because if you can afford it, then you'd rather buy a tangible asset than a fund.
Correct.
And if you can't afford it, then your risk profile is low. So why would you do this anyway?
Correct. So it's counterintuitive, like you rightly pointed out. SEBI actually made a mandate a couple of years back that the minimum investment of any of these products should not be anything less than 1 crore. So 1 crore becomes the minimum. So if 1 crore is the minimum, then automatically it filters out a large crowd of it. So second is that its minimum amount is 1 crore. Second is, why would somebody buy a fund? And then what's the reason if I can still afford 1 crore and I buy myself some real estate physical? But under the garb of diversification, saying that with 1 crore you can buy 8 properties across different locations. That's geographical diversification and property diversification. But I don't think it has served the purpose. So that is not a merit, but that's at least a feature, but if not a merit.
Again, real estate is usually a long gestation kind of investment. Is there a lock-in in real estate funds?
Yes, unfortunately there's a lock-in of 7 to 8 years.
So they're as liquid as buying a real property?
Yeah, they're very, very liquid. In fact, selling a property at least is far easier than selling a fund before 8-9 years. So
selling this fund is actually almost close to impossible?
Unless you find another person who can actually take it over for the residual period. And so it's been very, very, very few people are able to get exits.
Right. Is this still very popular right now?
It has lost some sheen and popularity, but I think still there are quite a few wealth management outfits who strongly recommend real estate funds, which is difficult to fathom.
Right.
If that's the kind of performance in the last 10 years, why would you want to experiment with your money and your clients' money?
Key features about private equity fund and your thoughts on this one?
See, private equity fund is investing into funds which are not listed, which are stocks which are not listed. When there's enough space of listed companies, trying to cull out opportunities there is more prudent. So private equity fund, again, I would say a no, because investing 1 crore in unlisted companies where the access of the fund manager to the management is of course there, but a mutual fund guy actually has a better access. So PE funds, a no-no. If you look at the 8 funds analyzed on the private equity space, the performance is similar, 5 to 7%, where the commitment during presentations made to clients was almost 20-25%. Unless the tide turns in the next 5-7 years, I would not touch a PE fund with a barge pole.
Very lastly, how tightly regulated are alternative investment products?
So in the last couple of years, fortunately, regulation has stepped in. They were very loosely regulated. Now there is a regulation which puts them under the SEBI's umbrella, which is called the Alternate Investment Fund Regulation. So regulation has become better. Transparency still is a big challenge. Affordability is a challenge. Performance is a challenge. And the risk is, of course, a challenge.
Right. With that, we've covered alternative investment products. Of course, these are not your traditional mutual funds, but clearly serve the purpose of managing a risk and, of course, generating the returns that your portfolio is out to achieve. We're completely out of time, so we'll wrap up this edition. Thanks, Feroze, for joining, and thanks for watching Financial Planner.